Hello, welcome again to this hybrid account. It's a YouTube channel. If you haven't subscribed, you can do subscribe for regular updates. Now, our topic today is based on borrowing costs. All right. What are borrowing costs and why do we study borrowing costs? We have several reasons to this. Borrowing examples, common examples of borrowing costs are the interest. When you go to the bank, you borrow and you have to pay interest. Now, the question comes, we usually explain that interest to the statement of profit or loss, but it really depends. There are situations that would require us to capitalize such interest costs. So instead of debiting to the statement of profit or loss, we have to debit to the associated asset. That's why we say we capitalize them. So borrowing costs helps us to know which costs are to capitalize and which costs to expense, right? All right. So by proceeding, say, IAS 23's objective is to prescribe the accounting treatment for the borrowing costs, as where related borrowings are applied to construction. Let's say you're constructing a certain asset, which we usually call them self-constructed assets. Maybe it takes a long time, it takes a substantial period of time to construct an asset. And so if you borrowed somewhere, you have to capitalize some of those costs, all right? This is the aim. So you're trying to know at what point should we capitalize the cost and at what point should we proceed expensing them as usual, all right? Now we can proceed.
Hello.
The following definition.
Hello.
Yes, yes.
Yes. Before you proceed, are these borrowing costs the same as bank charges?
They can be as long as they are related to the asset. That's why to call them borrowing costs, borrowing costs are, even bank charges are borrowing costs, but our main concern here is whether this cost of borrowing should be capitalized or not, because we usually expense them. So this should be your sole concern. Bank charges could be borrowing costs, but our question is on whether we should capitalize them or not. So interest, those charges are all borrowing costs. They are costs associated with borrowing, but you have to consider them if there is some kind of relationship to the assets that you are constructing, right? All right, so that's why you say borrowing costs mean interest and other costs incurred by an entity in connection with the borrowing of funds. So we will see this later. Now, there is something called qualifying asset, and this one is very, very important. As I told you before, we need to know whether the cost should be capitalized or not. If you capitalize something, that means you are going to add it to a particular asset, right? And that's why you need to know something called a qualifying asset. So a qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. This one should not baffle you, should not bring a lot of problems to you. Something just normal. Let me tell you one thing. Interest, suppose that you are being told that interest per annum is 10%, it usually spans over a whole year. Now, let's presume that you are making something and that something is taking just 1 minute to complete. If it is taking 1 minute, that means you would take the interest for the entire year and apportion it by 1 minute, which would be very low and it would be insignificant. And therefore, there would be no need to hustle to try to capitalize that interest because it could be somehow immaterial. All right? So that's why they say that it necessarily takes a substantial period of time. So that's why even the standard itself does not specify this substantial period of time is how much. That's none of your business. It's just like when you are doing something and you are given the period, just use it and capitalize. If it's immaterial, it would be seen, right? Okay, so that's why we are saying it takes necessary substantial period of time to get ready for its intended use or sale. All right. Now let's go take a look at what the standard list that may be included in borrowing costs, right? Borrowing costs can be capitalized in the following. Interest on bank overdrafts and short-term and long-term borrowings. These are just examples. We've gone to the bank, we've taken a short-term loan, maybe a bank overdraft, a normal short-term loan, a long-term borrowings for the sake of financing a non-current asset or maybe a current asset, whatever. It could be capitalized, but it's just a borrowing cost that as we know. But also, let's say finance charges in respect of leases recognized in accordance with IFRS 16. There is something called IFRS 16. It is a international financial reporting standard based on leases that explains leases. A lease is a kind of finance. Someone finances you through the lease, and you have to pay them finance charges, right? And so these finance charges could also be capitalized, right? All right. Let's say you have borrowed a machine. Let's say you have leased a machine and you're using that machine to construct your asset. That means those finance costs that you will incur can be capitalized, right? All right. Another example is exchange differences arising from foreign currency borrowings to the extent that they are regarded as an adjustment to the interest cost. Let's say you borrowed a loan, maybe let's say you're using dollars, but you borrowed a loan in pounds. That loan actually, to recognize it in your financial statement, you have to translate it to be in the dollars. Now, the foreign currency differences arising as a result of that one could also be capitalized, right? So, they are also borrowing costs. Just say they are borrowing costs because just saying borrowing costs doesn't mean capitalization. Borrowing cost, after knowing this is borrowing cost, then you assess it on whether it has met the criteria for capitalization or not. All right, so let's proceed. Defining, depending on the circumstances, any of the following may be qualifying assets. As I just told you, qualifying asset is just an asset that takes necessarily a substantial period of time to get ready for intended use or sale. So most assets, mostly any asset, except those assets that do not take time to construct, maybe they do not need to be constructed. For example, inventories. To make inventories, say you are a company that sells cars. In that case, cars to you would be inventories, so you could call them right that way. But also maybe manufacturing plants. You can have, this is part of PPE, power generating facilities would also be part of property, plant, and equipment. But intangible assets, even if it's intangible asset, do not be surprised here. You know, there are intangible assets that are actually developed. You develop it over time. Let's say development cost. So you can also actually capitalize it, right? All right. And then you could have investment properties. Investment properties are just properties, just as for PPE and the property, plant, and equipment. But by saying investment properties, we mean land and the buildings. But if you call it investment property, it is just different to that of the PPE in that it is held for rentals or capital appreciation, just that. So it can also be capitalized. And then you have bearer plans. These are just examples, you know. So the point to note is financial assets and the inventories that are manufactured or otherwise produced over a short period of time are not qualifying assets. This point is very, very important, but also obvious. Up here, I call them inventories, and they said that they can be qualifying assets. But down here, I mentioned them and they said not qualifying assets because they have stated that over a short period of time. If you are told something is over a short period of time, that means actually even if you capitalize the interest, they will be very low, they will be immaterial, so no need to waste your time. What about financial assets? Financial assets are just like investment in debt, maybe investment in shares of invested in a certain company. You do not need to construct the investment in shares. You just go, just pay the money, and you have that investment. So it's an asset that does not require a substantial period of time to make it ready, right? So we cannot say that this is a qualifying asset. All right, then you can proceed. Let's finish up about 2 slides and then we can just go directly to the questions, right? Yeah, so let's be patient a bit. Now, we are just going to the borrowing. Now that we know the borrowing costs and we know the qualifying assets on which borrowing costs can be capitalized, let's go and take a look at borrowing costs eligible for capitalization. Not all borrowing costs will be capitalized. And right now, that's where we are going. All right. So all eligible borrowing costs must be capitalized. If borrowing cost is eligible, that means it has met the criteria to be capitalized on a qualifying asset. And then only borrowing costs that are directly attributable, maybe to the acquisition, maybe you're acquiring something, to the construction, maybe you're acquiring, or production of a qualifying asset, like say inventory, can be capitalized as part of that asset. That one is also obvious, right? And these borrowing costs that would have been avoided had the expenditure on the qualifying asset not been made. By saying that the cost is directly attributable, what do I mean by saying directly attributable? That means it is the cost which, if I was not actually making that qualifying asset, I would not have incurred. Maybe I've gone to the bank to borrow, to take some loan so as to construct like a particular asset. So in case I was not going to make that particular asset, I wouldn't have borrowed. So by saying cost directly attributable, those costs should have some kind of connection to a particular asset. All right. Now, not one thing. But for borrowing, there are specific borrowings, but also there are general borrowings. And this one is the point at which you have to be very careful because everything lies on here. So for specific borrowings, which would mean borrowing which will relate to a specific asset, you have gone to the bank to take a loan of $8 million so as to construct a certain plant. That is a specific borrowing. They are totally related to a particular asset. All right. So for specific borrowings, this one is always very easy. It's always very direct. Even if you hadn't learned, you would have just gotten it, right? Because for specific borrowings, to know the borrowing cost is easy. You just take the actual borrowing cost, as you see here, incurred or not borrowing during the period, but you less any investment income on the temporary investment. You know what? Let's say you need $1 million to construct an asset, but initially you need only 60% of it. So you can say that as long as I've started constructing the asset, I will take the 60% to construct the asset, and those 40% I can temporarily invest them temporarily and earn some kind of investment income. So to obtain the net borrowing cost, you take the actual cost of borrowing and you less the investment income on temporary investment. That's what I'm just going to do down soon. We just go and take a look at the question. So let's be patient a bit again. So now let's go for general borrowings. We can go to general borrowings now. For general borrowings now, these are borrowing that the entity uses when the entity uses a range of debt instruments to finance a wide range of assets. So you are taking, let's say, 4 different loans to finance several assets. You are not specifying that these borrowings are for particular assets. No, you just have general borrowings, and whenever you need to finance an asset, construction of an asset, you just take there. So that in that case, we use a different approach. So we say that the amount eligible for borrowing cost is found by applying the capitalization rate to the expenditure on the asset, right? You have to use the capitalization rate. You cannot use the actual borrowing cost less investment income on temporary investment here. So you have to be very careful here. Now, how do you obtain this capitalization rate? It's just simple. It's just the total interest over total loans outstanding. That's why we say it's the weighted average of the general borrowing cost applicable to the entity borrowings that are outstanding during the period. So simply speaking, it's like total interest over outstanding loan during the year. No issue. We're just gonna see it later though, on an example soon. But now, not one thing. This way of general borrowings is not actually very, very realistic. So we usually say there is a cap on the amount of borrowing cost. Let's say that you have used this general borrowings concept and you have found that I have to capitalize 2 million, but the actual borrowing cost is just 1.5 million. That means you cannot capitalize more than what you actually incurred. So that's why you have a cap. So in case the borrowing cost computed using capitalization rate exceed the actual borrowing cost, you cannot capitalize that one. You have to take the actual borrowing cost. All right. And sometimes one overall weighted average capital cost of one weighted average cost can be calculated for a group or for an entity. Now this comes for consolidation of financial statements, but I think it's no big deal right now. Let you just know. So you can use a single for a total group, or you can use for each entity separately. All right, we're just heading to the uncharted waters, so just be careful. We are just trying to finalize something. Now, we said that we have to capitalize borrowing costs. Now, when do you have to start capitalizing? We need to know when do we suspend capitalization, but also when do we cease? Do we completely stop capitalization? So we have 3 different states, right? All right. The first one, 3 events or transactions must be taking place for capitalization or borrowing cost actually to be started, right? You have to have 3 different things happening. Actually, it's not one. There's something very, very obvious. You know, I got borrowing cost. I got the qualifying asset. So borrowing cost must be being incurred, but also the qualifying asset must also be in progress, right? So that's why we say the first point, expenditure on the asset is being incurred. The loan has been taken from the bank, and the loan is being used to fund maybe those workers, all right? So that's why we say expenditure on the asset is being incurred. But again, borrowing costs are being incurred, you know. By saying borrowing costs are being incurred, that means you cannot say that you haven't taken the loan yet from the bank, but you are capitalizing. What are you capitalizing while the loan isn't taken already? So that's why we say borrowing costs are being incurred, but also expenditure on the asset is being incurred. That is, the loan has been taken from the bank and actually it is actually being used to fund the construction. But also activities are in progress that are necessary to prepare the assets for its intended use or sale. That one should also be in progress. Let's say you are constructing something and labor comes on strike and they cease constructing the asset for 2 months. You cannot capitalize that one. All right. So let's start explaining some of these points here. By saying expenditure on the asset is being incurred, that is point 1, we're saying that expenditure must result in the payment of cash, transfer of other assets, or assumption of interest-bearing liabilities. I think now you're just getting the point. You cannot say expenditure on the asset is being incurred while nothing is being paid. It must result in the payment of cash, the cash that has been obtained from those borrowing costs, from the borrowing that we took from the bank. All right. Say deduction from expenditure will be made for any progress payments or grants received in connection with the asset. Actually, you usually won't find this one, so no, it's no big deal. All right. Now, in case maybe you don't have sufficient information, this one can be used, but actually I've never encountered this. IAS 23 allows the average carrying amount of the asset during a period, including borrowing cost previously capitalized, to be used as a reasonable approximation of the expenditure to which capitalization rate is applied in the period. You know, we are saying that, let's say during the year, I've taken 2 million from the bank to construct the asset. Now you have to use that one to compute borrowing cost. But let's say you do not know actually, you can just use the average carrying amount of the asset. All right, and let's go to this borrowing costs are being incurred. This one is obvious. We have taken the loan from the bank already, let's say. And the last point, we say that activities are in progress that are necessary to prepare the assets for its intended use. And this one is what we're just trying to speak of. Now, activities necessary should not necessarily be physical construction of assets, right? Should not necessarily mean physical construction of assets. These activities actually could be maybe technical or administrative work prior to construction. For example, maybe obtaining work permits. So when building, let's say I'm just trying to obtain work permit to construct this one, we say that activities are necessary. So you can just continue capitalizing, no problem with that. And then you're saying they not include holding an asset when no production or development that changes the asset's condition is taking place. Let's say you have suspended capitalization maybe due to labor strike. That means you cannot capitalize that interest incurred because the bank has lent something on you. So actually interest will still be incurred, but it won't go there. All right. And then we can proceed here. We can proceed right here. Yes, now we can proceed with this point here. First of all, I spoke of commencement of capitalization, and now I'm on suspension of capitalization. And now when you're capitalizing something, when you're capitalizing borrowing costs, there's a point at which you should suspend them. You should stop. I think I've spoken about this already, right? So suspension of capitalization, this is what could follow here. If an active development is interrupted, so in case active development is interrupted for any extended periods, borrowing costs should not be capitalized for those periods, right? I've given you an example. Labor has gone on strike, and although borrowing costs are being incurred by the bank actually by the entity to pay the bank, you cannot capitalize because actually the work is not active. The job is not active actually. The asset is not being constructed, right? And then we say that suspension is not necessary for temporary delays. Actually, let's say, by temporary delays, this one, you should not consider it very much, because let's say temporary delays, maybe you're delayed for 1 hour. If the delay is very temporary, even that interest incurred in that period would be very low, so you could just ignore it. But in an exam, you cannot say that, so you could just consider it all right? And then we can say cessation of capitalization. So should it come to the situation of cessation of capitalization, we say that once substantially all activities necessary to prepare the qualifying asset for its intended use or sale are complete, then the capitalization should cease. You cease capitalizing because let's say you are constructing inventory, you are producing inventory. Inventory is already complete. Why should you continue capitalizing while the actual building has ended? So this would be the end, right? Okay. And actually, when do you know this? This will normally be when physical construction of the asset is completed. Even if there may be some minor modifications, we could say that, oh, it's just a matter of modifying. So I could just cease capitalizing this borrowing cost, something like that. And then the asset may be completed in parts or stages. Let's say you're just making a 6-story building. You can just say start capitalizing the each floor at a time, right? So that's just something that you need to know. And the last thing to know is capitalization should cease for each part as it is completed. For example, you're making a six-story building, so each floor actually be stopping capitalization as each floor is completed. So it's just like that. Then the last point is about disclosure. Now, let's say you're going to the notes of the financial statements and then you need to speak something about borrowing costs. So what to disclose, first of all, is the amount of borrowing costs capitalized during the period. We just specify them, whether they come from general borrowings or from specific borrowings. But also we say capitalization rate used to determine the amount of borrowing costs should also be stated, right? Now you're just going to examples and see what we have to do when you encounter questions of this kind. Question 1. This question relates to specific borrowings, right? The question, on 1st January 2008, SB company borrowed $3 million to fund the production of 2 assets which were expected to take a year to complete constructing. Work started during 2008 and the loan facility was drawn down and incurred on 1st January. So the loan was drawn and incurred actually and was used as follows with the remaining funds invested temporarily. Now you see, this one is specific borrowings because the loan has been taken to fund 2 assets. It is specific that it is going to fund these 2 assets. All right, asset 1 and asset 2. And actually, on 1st January, this is the amount that was used, $500,000 for asset 1 and asset 2. And then on 1st July, $500 on asset 1 and $1,000 on asset 2. And then the loan rate was 10%, and the SB company can invest surplus funds temporarily at 6%. Now, these are specific borrowings, and we said that for specific borrowings, you shouldn't worry about these funds invested temporarily. If funds are invested temporarily, you could just complete borrowing cost and relate this investment income to the cost of the borrowing. Now, required. Compute the borrowing costs to be capitalized for each of the assets, and thereby the cost of each asset is at 31st December 2008. So we have to start all right? How do you obtain the borrowing cost to be capitalized? Now, not one thing. I just said that this one is a specific borrowings. If borrowings are specific, do not worry at all. Just compute the actual borrowing cost, Now, you'd ask yourself what you do for asset 1 and for asset 2. Now, for asset 1, I needed $500,000 and then another $500,000, giving you a total of $1,000. So, for asset 1, I would say that borrowing costs are equal to 1 million. This was 1 million, eh? 500 plus 500 equals 1,000, but it is in $1,000, so it's 1 million times 10% the loan rate. and I would have $100,000. And then for asset 2, I would have 1 million on 1st January and another 1 million on 1st July, giving you a total of 2 million. So I would take 2 million times 10% and I would have $200,000, right? These are the borrowing costs, and now we have to less the investment now. Investment income. What is investment income? Now, to obtain the investment income, you ask yourself, for asset 1, I first invested $500,000, but I invested another $500,000 on 1st July. So I did not need to invest. I did not need to. I mean, I used $500 million, $500,000 on 1st January, but I needed another $500,000 on 1st July. So I waited 6 months. So I could invest this $500,000. I could have invested this $500,000 for 6 months before needing it. So you just take $500,000 times 6%, that is investment income, but only for 6 months. So you apportion it, and the remaining $15,000. I would less it from 100. And then as for asset 2, I invested $1 million, but I needed another $1 million after 6 months. So I could have invested it temporarily for 6 months to obtain 30,000. And then I just less than 100 minus 15, and we would have 85, and 200 minus 30, I would have 170. So this would be the borrowing cost to be capitalized, right? Yes. So actually we are done with this. And maybe this question said compute the borrowing cost to be capitalized for each of the assets and thereby the cost of each asset, right? Now, the cost to be capitalized, they are now known. And how do we obtain the cost for each asset? Cost of each asset, that one would be simple because I'll just check. For asset 1, I used $1 million. And if I said $2 million, but I have to capitalize them. So I have to capitalize the borrowing cost. So I will add 85 to asset 1, and then I would add 170 to asset 2, giving you a total of these figures here. All right. What if you are told to do maybe the double entries for borrowing costs? These are the double entry for borrowing costs. As for asset 1, we said that we had the borrowing cost of 85, meaning that I had to debit the asset by $85,000 and the credit cash of $85,000. Suppose that I paid this amount. And then for asset 2, I would have to debit asset 2 by $170,000 and credit cash by $170,000 again. And this one actually would be over. So